Morning, everybody. Welcome back to the Opportunistic Trader. It's 11 a.m. on November 8th, and we're now joined by Brynne Kelly, the Fundamental Angle, and Mike Korn. They've been joining us regularly, talking about all things energy on Thursday mornings. And there's a lot to talk about today with natural gas moving higher all week and crude oil moving lower. So I'll let you guys take it from there.
Sounds good. Thanks, Mike.
Thank you.
Hello, Mike.
Hey, good morning.
Good to be here. Good morning, everybody. Michael and I are here as usual to talk about the natural gas inventory numbers and crude oil, and as much as we can fit in for the next 30 minutes or so. So let's get to the inventory numbers first, which just came out. The market was expecting around 59, and the number came in at 65. So, I took the wind out of the sails, I suppose, a little bit, as the market was just kind of perched, hoping that would be something that would make another move higher, and it got a little bit let down on that. But I wouldn't say it's any sort of bearish indicator or anything like that. It is what it is. The futures contract for end of storage, which is the end of the storage season, expired today. So with today's injection of 65, that futures contract will go out at 32.08. So that rolls off the board today. It settles based on the final storage balance that we had today. And the next prompt contract, other than the weeklies, will be the end of draw storage futures. So this next chart, I kind of put this out every day, but I thought I hadn't done or presented it here. I always take a look at where the current storage level is. So if you start on the left, you have in the yellow the 5-year average, last year's storage level, and the current storage level for the same week. And you can see now we had the 65 come in, and the futures went out last night. There's the weekly storage futures that trade on ICE. The contract symbol is EIW. Went out last night trading 59. So we obviously came in 5 or 6 higher than expected. And that leads us to an ending balance of 32.08. And last night, the end of storage futures contract settled at 32.06. So it's a 2 difference on the expiration of that contract today. And then you can kind of, we've seen it every way in every chart, compared to in the pink, which is where we were in inventory last year, almost 3.8, and the 5-year storage level is 3.85. So 6 or so hundred below, and that is what the market's been thinking about and talking about forever. It is interesting just to note the next 2 weeks, even though the storage futures contract expired, the market at the moment is still expecting an injection next week of around 38. Certainly that probably will change tonight after everybody updates their models based on today's number. They'll recalibrate and see if that's going to change. And then it looks like going from there, the market starts anticipating withdrawals as that next futures contract for that third week is looking for a draw of 72. And the end of draw futures settled last night at 14.30. I mean, now those nobody has any idea right now. And that's moved a little bit over the last few weeks, kind of up and down, up to 14.90, down to 14.30. It's unclear. Nobody has any idea yet what draw numbers look like. So the projections on that are pretty slim. So I take that with a grain of salt. That certainly would be higher than we ended the season last year. We ended winter season last year at 13.35, and then actually continued to drop. And the 5-year average is 16.40. So I'd say that's probably likely to come down, but it just depends on the supply demand picture as we move forward. So we injected, now finally here you can see the picture for the summer. It was, fairly okay injection season, ahead of the last 2 summers, but behind, the prior years. So made up a little bit of ground at the last few weeks here. And I guess next week we'll count to help make up a little ground as well, but not really do enough to change the overall picture. It looks pretty much the same in every region, the overall inventory levels. Although, as I keep talking about every week, we still have that big deficit in the South Central. There's deficits everywhere, but it's most glaring in the South Central. And that's where we also saw the biggest injection this week. So finally, stepping up and getting some gas in the ground there. But not enough, to make up for dragging their feet all summer long. One thing to note, it's funny because we had that big price move on Sunday night and into Monday. And I went on and we talked a little bit about it with Mike on Monday. There was a change in the overall weather forecasts. It kind of validated cold for next week. And the market got ahead of that, got in there and started buying. And then we haven't done much since then, except for volatility. Implied volatility kind of keeps moving around, whether it's, bullish or bearish. Before the number, we had vols of, 41.7 in December, 50.5 or so in January. And those came off about a point after the number. And I think maybe the market started selling off a little bit right before I came on. But, for the most part, the outright contracts weren't moving very much. So definitely people are using, implied vol as their bull bear sentiment, the same way that they're using the spreads. And I don't know, do you think, Mike, is that something that's pretty common that you've seen?
Can you repeat that? I was looking at the chart of the vols.
Just that you don't have much movement in the underlying product itself, but, whenever the gas seems to stall out or not be moving up, the implied vol goes down, and especially when the market comes off in natural gas, right? It's the opposite of just about every other market. When the market sells off, vol goes down.
Yeah.
And when the market goes up, vol goes up.
Yeah, that along with so many times you see a natural gas move, a nice move, and then it'll just get stuck there for a while. And so I think that's reflected in the implied vols to a certain bit.
Yeah. And, at some level, it almost makes you think that December implied vol at this point, even though, we still have I don't know if it's 20 or 19 days left, might be too high if we're just going to kind of have made one move and hang out here, like as we've done with other natural gas moves, because we now are faced with, we have the reality of dealing with the cold weather next week. And I use that in quotes because of course it's November cold weather, not January cold weather. So it's certainly, it's that some places get a 3 handle for, temps at night, but certainly way above that during the day. So we're not talking about any sort of massive polar vortex, but, right now we're just going to sit and see what, so we walk in, what does the market do tomorrow as they're buying the 3-day cash package? So tomorrow, cash gas will trade for Saturday, Sunday, Monday. And I think Monday is kind of in the heart of one of the colder days on the forecast. So it'll be interesting to see what that cash package looks like over the weekend. And then we'll always have the Monday as everyone walks in and has to true up, based on, if they're just like last weekend, did they buy enough gas? How did the system, overall supply demand balance? And if that tends to be an impetus Mondays after a weekend when there was maybe some weather, because then they'll have to start buying for Tuesday. So we have kind of this next few days where I think that would be our next impetus to see the market move higher if cash comes in really a lot stronger bid. As it's been right now, cash sort of moved up to 350 at Henry Hub and is sort of hung right around in a 345 to 360 range. And so it hasn't really, given the market like the complete green light to make another move in either direction. So look for tomorrow, the 3-day package, it trades up until about 11 a.m. and then we switch over to starting to trade Tuesday. So it's definitely something to watch and keep your eye on and see what that does, see how strong the Monday effect is on the Saturday, Sunday prices. And then in the afternoon, what people start doing for Tuesday. But then beyond that, the forecast is, we have this sort of much below scary looking map for the, 6 to 10 day outlook. But then, kind of backs off a little bit. And keep in mind, these are below normals in a November month, not a January. So it has kind of a different meaning. And as the temps get a little more mild, we also roll into the Thanksgiving week. And that's a week where schools are shut, some factories shut down. It's certainly more so over Christmas, but there can be less overall demand just from the way vacation impacts what businesses are open, et cetera. So certainly I remember back in the days of trading power, somebody told me early on in the beginning, I don't care what the bid is for Thanksgiving, just hit it. Just hit it for Thanksgiving. Right. And that's for obviously the next day electricity, right? So it's like I don't care if they tell you, show you a 10 bid, you hit it, whatever it is. So just, I wanted to throw that out there so people are thinking that, if they're looking really for a big impetus, you do have that holiday week out there ahead of you. And this is just such a stubborn gas market. It's fearful, but unwilling to, really play out the storage narrative through just outright price. It's certainly looked to play it out through spreads. And Mike, we have been talking about that, I think, since we started kind of doing this little show about how these spreads have just, it doesn't matter which one you're looking at, Dece Feb, Dece Jan, they're Feb March, they're all at levels that are just way outside of historical patterns. And so that's a nod to the inventory level, but it also makes those positions very vulnerable. You have a Dece Feb spread where right now, and I think actually this morning it was 13 cents, December was 13 cents over Feb. Mm-hmm. So, anybody who would look at any chart, right, they would see like something that has just gone straight out, breakout. It's pretty hard to call tops on things like that, but it also makes those holding it nervous.
Oh, they're very volatile.
Yeah. And so, if you're going against the norm on a spread like this, and you could easily see when December expires, it evaporate to under January. There's not that many days left here for people to hold on to that conviction. And I don't know, Mike, what do you think? Let's say we just sit and bounce around here at around 350. Just, let's say a dime, give or take, for the next week or two. Mm-hmm. I think that Dece Feb could get vulnerable.
Yeah. Just focusing for a moment just on the spot month as a guide to that spread at 352-ish right here. The action we're seeing this week after the spike up to these levels reminds me a little bit of the last couple weeks when the market would weaken after originally making that 330, 335 high in the spot month, and it would come down to about 315 and keep bouncing.
Yeah.
That's what I'm thinking might happen here in the spot month. Again, just an observation that we've come off from the highs, but doesn't feel like there's a real strong desire to sell it here. And so with that in mind, I think we're going to retest the highs and possibly break through, to be honest. And again, I think the if it's a case of the dog's tail, in this case being the spread, wagging the dog being the flat price, I think we could see the flat price, I think we can continue to see the spreads keep trading higher. Because
and actually the interesting way that could happen is if there's suddenly we see some buying in Feb.
Yeah.
Outright, right now or in March, whatever, right now it's sort of been so concentrated that people run to the front contract and sell whatever you have in the back. If you start getting some buying in the back, it might be enough to get the front to, rally even more.
Yeah. Plus, do you remember last year when we first saw that Feb March spike like that? Why, Feb's premium over March widening in the way it did, which was a spike. I remember the last week or so of the Feb contract, it never gave up. The Feb continued like just about every day, higher highs going into the very end until expiration. There wasn't even like one day, okay, there was the correction.
Well, yeah, and that's so interesting because you either had to have just had it on and it made, it made its gap to a new level. Yeah. And then basically it was just at that level.
Yeah, like a limit bid day kind of.
Yeah. So, maybe we're just going to, here we got D-Smart, or you could say D-Scan, right? That one, but that's almost flat. So,
so I'd be really nervous to take a short position in the spreads, even though there's a certain contrarian in me that wants to, and saying like, what are we doing up here? But again, based on the experience, and I don't want to mess with that spread as a seller.
Well, and so that kind of brings me actually nicely into my next slide. So
I love this chart.
As a gas and electricity trader, in some of my past history, certainly there is a shape to the futures price curve that gives a nod to the fundamentals of the commodity you're trading. It's the reason that like August electricity can be trading $200 electricity futures, right? And September can trade 35 because it's just a completely different supply demand picture. And we're talking about a commodity that is real time. It literally, the prices can spike and be so volatile in real time. And natural gas has a lot of those tendencies. And that's why we see prices, for example, shoot up to $100 in some of the basis hubs in
like the New York Harbor stuff.
Yeah. And so I thought it would be interesting to take a look at, natural gas average monthly production versus consumption. And the pink bar on this chart is average monthly consumption. And the blue is average monthly production. And so, of course, you can see that in the summer months, we consume less than we produce, and it goes the other way in the winter. And hence, that's why the Novi March strip tends to always trade at a premium to the April-October strip, just because, you have buying that comes into the market, and it's that extra molecule is coming from storage. And what value, does the market want to place on you taking that out of the ground since you've held it there and whatnot? So there's more scarcity pricing. And then you take a look, I kind of highlighted out DEES and Feb. And it's kind of hard to look at the outright numbers because February has less days in it than December does. So, the numbers will look a little off just from a total monthly consumption because there's less days. But the spread historically has always been that the gap is wider in February. And I think that is why historically the market has tended to value December, as you can see on here, below February, because number one, the supply demand gap is wider in February. And, number two, you're more at risk of running out of, operational issues in February than you are in December. So, I think there is definitely a kind of a push-pull going on here, between those who want to fight, using some of these fundamentals and those that, just want to, go with it and respect the fact that this is a market that buys the front. and you just have to respect it. But I think know your vulnerabilities. Know what you're vulnerable to on some of the fundamentals. And then I just took this chart one step further and I added on numbers that we have so far for 2018. And the light pink in this case is consumption for 2018. And the light blue is production. And in both cases, right, they're higher than the previous 5-year average. Surprisingly so for production, right? And somewhat so for consumption. So we haven't had a look yet at this upcoming winter with, this growing level of production. And that is, what keeps this market from just outright running, right? Just like it was gapped up 30 cents and then it'll be up another 30 cents. I think it's why there's this, these pauses and hesitation, but it really doesn't matter because I think these spreads have exposed how vulnerable this market is to the storage levels. It's exposed to any real weather. And the market players showed their hand on that, in this last forecast. The market ran up, all the spreads blew out and gapped higher. It's very vulnerable. And so I think, it's not the only vulnerability to the downside is, that we're picnicking, in New York on Christmas. And, I think a couple Januaries ago, using the hot tub or the swim spa, in January. Yeah. So, but that, let's try to say, that's an anomaly and we won't know that till we know it. And to try to, get ahead of that at this stage in the game, it's too early. So I would say it's much more exposed to upside. And the market finally showed us that it knows that. So that's good to know, I suppose.
Thanks for bringing that chart up. That is a chart that really reflects very easily what's going on and gives a good context to why Fed March has spiked, why Fed has outperformed March on the way up like this.
Yeah. Oh, well, yeah, good. It's always, of course, fundamentals versus sentiment, right?
Yeah.
But, even unless you're just literally algo trading the contract, everybody cares about fundamentals or they wouldn't look at the storage reports.
Right. Otherwise, if you're not an oligo or an oligo predator, here's a great example of supply and demand integrated with sentiment, in my view. Basically, looking at this chart and Fed March performing.
For sure. And, it was just before we move on to crude oil real quick, last week we had talked about trying to do some option structures and you had, really had just wisely suggested, buying a Feb call, selling the March strike 25 cents higher. And I think this morning, right, we were looking at it and it moved since, we talked last Thursday. I think even that call spread, it moved out 9 cents or 7 or something like that. So,
what we looked at and discussed was buying the Feb 350 call, selling the March 375 call. The Feb strike was about 8 or 9 cents over the March. And when I looked earlier this morning, it was 14 and a half cents over.
Yeah.
The big reason there is with Feb, and basically over the weekend, we got to the Feb 350. We got that to an at the money.
Yeah.
Where the March 375 still has a delta of 30-ish, low 30s. So you saw the gamma at play with the Feb 350 call getting to at the money way before the March 375. Again, it benefited from the up move.
Yeah.
I thought there would be a little bit more premium based on what I thought would be a higher vol, but you mentioned the vol that it didn't really from here this week explode at all.
Yeah, that's the dang problem about, trading a lot of these natural gas options is that there's so much premium built into them with vol so high already that, like I think I was talking to Michael at Opportunistic Trader on Monday, and, the straddle, 350 straddle in December was like 32 cents or something like that. And, we just had a 30-cent move, but you might not get another 30-cent move before that expires. And so it's so frustrating on a lot of these options. You pay so much premium, and then when they get at the money, you didn't get anything.
Yeah.
So I like some of these spreads and looking at that. And I think that's also why people, in lieu of that, actually just trade the future spreads, right? They'll look at some of these spreads as a better play than the options themselves.
Yeah, especially with the movement we're seeing in the spreads. Obviously, there is risk, but there's some fantastic movement where you could trade the spreads, put in stops, trade it like an outright, and get good movement.
Yeah, more than you can get. The bid ask in these nat gas options are, they're not that tight, and it's not that liquid, and you don't end up getting. You really just have to put them on and sit around and wait, or you trade a bunch of Greeks. But anyway, okay. So you've seen some interesting stuff on crude oil this morning. So I thought it would be good to just, we had our inventory number that came out. And I think what's interesting sort of about the last several years in crude oil, this chart I have up here is year-to-date inventory change versus, the same week in prior years. And what I think this chart just sort of, in hindsight, highlights so well is you can see, from 2014 to 2017, right, to the end of 2016, really, we were building crude oil a lot, in 2015, and then, kind of kept, that build going, or, into 2016, and then turn around and went legitimately the other way in 2017. And I think, Mike, maybe I'm not remembering my years right here, but in 2015 and 2016, the market was still very much in contango.
Yeah, because I don't remember exact levels, but yeah, that followed the severe drop down to $30.
I think,
I forget the exact years.
Yeah, but when a market's in contango, you expect people to put molecules in the ground, right? So it's it's like this, and then when a market flips into backwardation, you expect to draw all of those barrels out of the ground, right? And the market did that.
Yeah, because it says, I think we flipped into backwardation then sometime in the summer of 2017 when we first got above $50 and started to hold there, if I remember correctly.
Yeah,
I don't have the chart in front of me. That's what I kind of recall.
And, I suppose the black line here is the total. So if you want to look at just crude, it's the green. And so it's a little less dramatic, right? We did draw crude, but I look at the whole complex because, in theory, the products are, they're the same. They are crude oil, right?
Right.
So anyway, interesting to know. And now we're seeing the market over the last month or so has really moved into contango. And, first it was maybe just the first month, and then it was month 1, 2, and 3. And now, how far, I think you were saying you're watching it just kind of move down the curve.
Oh, it accelerated this week. I believe on Monday when we came in, July was the highest priced contract, the highest priced month on the curve. And this morning it's now December. It was like every day you could just watch it rippling, that contango rippling back.
Moving, they're taking all the backwardation out of it. And, it gets, when you sort of talk about overall the market, the reason that I thought it would be good to take a look at this sort of picture and talk about it is that contango, it brings storage into the market, right? So in theory, producers are fat and happy, and they pump it out and they put it in the ground because it's worth more in the future.
Right.
And that tends to kind of reflect as bearish initially, right? That and instead of a normal market reaction, and kind of can feed on itself, and especially a market that has gone through this big sell-off, or that we had, all the way down to $30 or whatever, and a slow grind higher, trying to kind of get everything worked through the system. It's on everybody's mind, and so the minute we start to see crude building, it will be thought of as if we've already injected the total of 2015, right? Like as if that's the picture, instead of it just being a normal amount of contango, which crude oil historically has. That's how the market works, right? And I think even speaks to, like, you see more business when the market is in contango.
Oh yeah,
as a broker, right?
Right. The idea there is, if you're a producer, it's more comfortable thinking about locking in, selling a higher price in the future, and that's what contango, the price.
Right, regardless of what the price is, right? I mean, it's crazy. When we were up at 70, 71, it wasn't as if like, oh, where are producers? No, because the market was backward.
I've seen backwardation in contango down below, like near $10 to $15 a barrel for oil, and at $120 or $110. I've seen backwardation and contango. The flat price doesn't reflect so much the backwardation contango, but it's definitely impacted by it.
Yeah, you get a lot. Producers are more enticed to come into the market when it's in contango.
Yeah. Can I point this out, just as far as, producers tend to look, 6 months, 12 months, 18 months out in the future. And what I've been following is not just the front month performing weaker than, than the December and over December of 19, but I also look a little further out. Today, Cal 19, 62, right here, 62.55 bid. First half 20 is higher at 62.75 bid. So that first half 20, Jan 20 to June 20 is actually 20 cents higher than the entirety of Cal 19, the Cal average price. Just last week when we spoke, that Cal 19 was roughly $1.50 over the first half. So the contango's been pretty, or the shift, the price curve changing like this has been pretty dramatic. And
you do a lot of, it's interesting to hear you talk about second half and the Cals, but actually there's a lot of
that's the issue, the curve that
trade those spreads, right?
Oh yeah, or trading. Not so much trading one strip versus another strip, but positioning their exposure, positioning their risk into those strips.
Right, just moving it further out on the curve, right? Yeah, so now they're selling the back half of 2019 and buying 20.
Right, and exactly. Actually, I'm not seeing so much buying of 19.
Selling 19 and buying 20.
I'm seeing the selling of Cal 19 beginning to pick up, and the selling of first half 20 beginning to pick up as the curve is being restructured, as we're getting into a deeper contango, meaning the further back months are going to premium over the near to delivery months.
Yeah, I mean, it's interesting how far out they're trying to look for the better price.
Yeah.
Right. And they weren't, it's funny, at $70+ they and literally Cal 19 was bid over $70+ people weren't looking, right? Because it was, the front was over, so they don't want to sell the back.
Right. And if you think about this past year, even though the market's been strong, it's been bullish, there were times we corrected $5 to $10 in a short period of time and then ultimately build back up towards that 65 and building back up to 70. We've had drops in the market, maybe not to this extent, but in those drops, since we first went above $50 a year or so ago, we didn't have backwardation, and we didn't see any. I'm sorry, we had backwardation, and we didn't see any really change of that when the market was correcting.
Right, now, you're right. So this is actually different than other sell-offs that we had this year that have had literally little to no impact on the backwardation throughout the curve. Let's say like DCE or just the monthly spreads. It is now, and it has been for the last month or more than that, and that's something to note, right? It is a difference in this sell-off than the rest of this year.
Yeah, and again, as a broker, I'm excited about that, because this is where I begin to see, in the past, this is where I begin to see more action from producers coming into hedge. Again, with the whole idea, I want to sell to lay off my risk. It's easier for me to sell the back months at a higher premium than the front months.
And, I completely jumping to something different here. I'm looking at the structure of the crude complex here on this chart. And it reminded me that, and I don't know if you had any conversations with anyone about this, the CME launched their WTI Houston contract on Monday. And, because of course, the pipelines, that are scheduled to be built mostly are of the caliber of moving oil out of Cushing down towards the Gulf Coast. I mean, certainly there are pipelines that are, trying to get to inland refineries in Arkansas and whatever, but moving it, let's just say south for the most part. And yet you see right now, WTI Houston is $6-7 over WTI Cushing. It'll be interesting. I mean, it's a long ways off, right? We're end of 2019, beginning of 2020 is when a lot of them, at least at the moment, are scheduled to come online. To see if that does anything to these spreads. I mean, of course, they're not going to be flat because transportation costs money, right? So it costs money to move things around.
Yeah.
But, I've been looking at the structure of the curve and just the whole complex, right? From Brent to, the WTI, different locations, Midland and Houston. And if, sometimes in these big sell-offs, you'll see maybe some of the spreads narrow or widen. And that kind of tells you if, there is a more bullish or bearish sentiment. And really, the thing, for the most part, in this sell-off, it's not like the sell-off that we had when we were going down to $30 and all of a sudden, all the other, Bakken crude and everything was $19 below the screen. And, there was just getting dumped everywhere. Most of the spreads have remained relatively firm, except for Western Canadian Select. So the Canadian crude, it almost seems like, the West Texas crude is getting a little bit more value and certainly, is hinging itself on, being the first to be able to be exported once it gets, physical capacity for it. But, the Canadian crude is still so severely hindered. And so it, just that the bottleneck. And so that spread is, the discount of Canadian crude to WTI seems to be the only one really that's blowing out. But, WTI Brent, WTI versus LLS, most of those spreads have stayed, relatively the same, which is interesting. I mean, I don't know if that just points to strong Gulf Coast demand and stronger global demand and sort of a domestic picture here. And anyway, just I like to look at the overall complex. If something is weaker than something else, then it tells me a move is more real or not real. And we've seen the structure and the shape of the curve change from backwardation to contango. But I don't know, are we going to see any of these spreads change? Or is that the next thing that comes under fire?
I'm not sure, but one thing I just wanted to add is I'm seeing in like the last year or so in the industry, more people at different banks saying, they no longer say I'm a crude trader. I'm hearing I trade grades, and there's definitely more, so I'm just wondering if the industry is gearing up to trade more.
That's interesting because, Cushing is almost, becoming just such a blending complex. It's getting in so many different gravities, right? It's getting in like Bakken shale gravities, and it's getting in heavier Canadian type gravities. And then it's essentially blending it and sending out, a blended grade for export. Based on, and a lot of the new pipelines that are coming online are going to have the capability to batch, meaning that you can put like a Bakken, high, low gravity onto the pipeline and get the same thing out. So, you can, and because that's what the overseas customer wants, is that specific gravity. And you don't have to do all of the blending necessarily at the, just when you get down to the coast, like blend it and then unblend it. So certainly a lot of the dynamics are going to be changed. So I could see that why they'd say they trade grades, right? Because grades are, since I've known it, it's always about, any merchant desk I sat on, it's about blending, right? You just try to buy whatever components you can, put them together and, to make a higher priced, get it into a higher priced market. But that got a little bit, dicey in the last couple of years because we're just so flooded with this new shale production without the capacity to kind of think through immediately what to do and how to get it to the next market. I remember back when I worked at Coke, it was all about gasoline blending and the tanks and the terminals and buying all the different components and getting to produce a specific grade for much cheaper than futures or the outright gasoline market was trading for. I haven't looked at it at all in a while to see if those grades, like what that ARB is. But certainly the ARBs are the thing.
Right. I say I've only been to Cushing once, about 6-7 years ago, and I just was amazed in how vast a place that was. And I'm sure you've been out to Cushing, but I was just surprised.
Enormous.
And
it's not just like one. It's not a thing. It's like a city.
No, it's bigger. And they had land, so much more land to expand. It's kind of crazy how vast
I did read that the expansion of storage capacity is ramping up over the next year or so, and a lot of that is due to so they have more capacity to blend various things. And so just when at least a couple of articles I saw, I think people are trying to say no, Cushing is still the viable place, and I have no opinion either way, right? But essentially, it's like don't count Cushing out here. It is the blending capital of the world, and it is the pipeline capital of the world. So, that capacity is expanding. And what's interesting about that, and I know we got to wrap up here, but 2 years ago, when we started expanding storage capacity in the Gulf Coast pretty dramatically, we, of course, filled that capacity. And so by comparison, storage looked high. Without any respect for the fact that you just need more operational capacity to, facilitate exports and move all the different grades and whatnot around. And so, I don't know, it's just something to think about if we're all of a sudden going to add what is storage capacity in Cushing, like 100 barrels or something like that. If we're going to add something significant to that, now the historical comparisons are just going to look different. And, because it's for a global purpose. So, because the reason that they need that capacity is to get the right crude down to the Gulf Coast to get it out of here.
Yeah, as far as a visualization of that, if you're driving outside, away from New York City on the turnpike, you see the tankers there. I think those big tanks that hold something like 100,000 gallons, maybe. I'm not sure. But what I saw at Cushing was what they were in the process of building. And again, this is, I don't know, 5-6 years ago. They were building tankers, I think, that were able to hold something like 600,000. They're huge. Yeah.
Wow. Yeah, it's big complex. So, a lot going on, big moves this week in both commodities. I think maybe crude was actually more the surpriser than natural gas, right?
Yeah.
Everybody expected natural gas to move up at some point. So it's good to do a debrief with you today, and hopefully, people got some thoughts to chew on, about some of the data and how to think through it that's coming up. And we'll be back again next week to talk to everyone.
Okay, good discussing things with you, Brynne. Thanks.
Yeah, good to talk to you, Mike. Thanks, everyone.